Hello, everyone. Welcome to Introduction to Investment Principles by myself, Mr. Wall Street. Um, Today we're going to be going over this PowerPoint presentation here. I hope you enjoy it and learn something new to help your initial guidance here for investment principles. Okay, so let's dive right in. So, um, welcome to the immersive journey. Um, This is going to be a introduction to investment principles, as I said. Once again, I'm Mr. Wall Street. I'm thrilled to be your guide as we go through the foundations here and underpin successful investing strategies. Okay. In this presentation, we'll go a little bit beyond the surface, and we'll dive a little bit into each concept, and also try to support it with real-world examples and practical scenarios. So buckle up, prepare to be equipped with the knowledge and insights we need, as a team here, and we're always learning together to navigate the complexities of the investment landscape. Okay? So first things first, let's go to the next slide. We are going to go over the types of investments. Okay? As we go over this landscape here of the investment types, let's imagine the financial world as a vast terrain with various avenues, and each one offers unique opportunities but also has their challenges. Okay. Consider the world of stocks. Okay. Imagine you're an investor. You're interested in technology companies. You decide to invest in shares of a well-known company like Apple, right? As the company innovates and releases new products, its stock price fluctuates. Over time, if Apple's performing, strong, your investment could grow, allowing you to potentially benefit, right? Capital appreciation, and Apple also has dividends. Now, if we were to shift our focus onto bonds here, let's envision a scenario where you lend your money instead of, you know, buying a share of stock. You're lending your money to the government by purchasing a treasury bond. In return, the government promise is to pay you regular interest payments, also known as coupon payments, over the life of the bond. And then when your bond finally matures, you will receive your initial investment known as the principal. Now, let's say we imagine you're a risk adverse investor and you opt in for safety of mutual funds. Mutual funds pool together money from various investors and invest in a diversified portfolio of assets. For instance, the S&P 500 index. It tracks the performance of the 500 largest publicly traded companies, U.S. companies, and by investing in this type of fund, you will gain exposure to a broad range of stocks without the need to pick individual companies. So just to clarify, it's a broad range of stocks that that this mutual fund is investing into. So this way you don't have the responsibility of picking an individual company, right, and hoping it does well. If we go into real estate investments, suppose you purchase a rental property in a prime location. Over time, you're gonna collect rental income from the tenants, which can provide you with a consistent stream of cash flow. Additionally, right, if a real estate market appreciates, the value of the property could rise, right? Also, potentially leading to capital gains. Commodities. So like commodities, imagine like you invest in gold, precious metals, often considered the safe haven investment, right? In times of economic uncertainty, typically the demand for gold tends to rise, right? Causing a price to increase. This potential for appreciation is a characteristic that draws some investors to commodities. Lastly, here on this slide, if we venture into the world of alternative investments, right? Imagine you're intrigued by the digital revolution and you decide to invest in like cryptocurrencies or, commonly known, the main one being Bitcoin, right? Cryptocurrencies operate on a decentralized blockchain technology and can experience very, very extreme price volatility, which means going up and down very quickly, right? And while their value can skyrocket, right, they also carry a much higher level of risk. Um, so, Continuing on where we left off, slide 4 here is risk and return. This is our voyage now is taking us to this crossroads of two fundamental elements that shape almost every investment decision, right? Think of risk as the weather conditions on our journey, and the returns as the treasures that we unearth. Consider the risk, or considering the concept of risk through a lens of investors evaluating a technology startup, right? This startup promises groundbreaking innovations, but as a newcomer investor, like potentially yourself, you would face higher uncertainty compared to established company like Google, right? While investing in this startup might offer, potential for like significant returns, right? It could become this huge company. It's also going to expose you to a much higher risk, as company success is not guaranteed, right? Some companies go bankrupt, some companies can like turn into the next Google or Apple, right? But companies also fail. On the other hand, right? Let's imagine you're assessing a mature and established company that's been like the leader of its industry for decades, right? This company has history, steady growth, and reliable profitability, right? Investing in such company like this might offer more stable returns, but on the other hand, the potential for the explosive growth might be limited compared to the riskier ventures, right? Uh, this interplay between like risk and return is the essence of investing, guys. Understanding your own risk and tolerance and aligning it with your investment goals is paramount, right? The more risk, the more potential return. Summed up in a nutshell here. Let's go to the next slide. So slide 5 is diversifications. As we're going through this presentation further, let's unveil the armor that shields us from uncertainties of the market. The art of diversification. Like imagine you're a chef, right? You're preparing a big feast. Just as you wouldn't rely solely on a single ingredient, diversification involves spreading your investments across a variety of assets. Okay, guys. This strategy mitigates the impact of poor performance. I have a terrible time with P's. In any single investment, right? So it's basically spreading. Like you ever hear the saying, right? Don't invest all your eggs in one basket. It's talking about diversification. Now, suppose you're an investor who only holds shares of technology companies in your portfolio. Um, if the tech sector experiences a downturn, well, your portfolio could suffer significant losses, right? However, if you were to diversify across the sectors, like different sectors like healthcare, finance, energy, right? The underperformance of one sector can be offset by better performing sectors, across your portfolio here, right? Diversification extends beyond sectors and includes different asset classes. Let's imagine you have investments of stocks, bonds, and real estate, right? If the stock market experiences a slump, your performance with bond investments and real estate holdings can, provide like this extra stability to your portfolio. So not only can you diversify your sectors, right? You can diversify your assets as well. The key to finding the right balance between risk and diversification is key, right? Just as a ship equips itself with various sails to navigate different wind conditions and sea conditions, Your portfolio should also be well equipped with diverse assets to navigate the ever-changing currents of the market. Because one thing I've learned, and I've made a lot of money, I've lost a lot of money, is the stock market does not care about your feelings. Okay, guys, make sure you get that in. The stock market does not care about your feelings. Okay, so we're gonna pause here. We're gonna go to the next section. Give me 2 seconds, and we'll be right back. Welcome back, guys. We are now going to dive into slide 6, which is the time value of money. Okay. Uh, this is a crucial concept that underpins financial decision making and the time value of money. Okay. Let's imagine you're offered $1,000 today or $1,000 a year from now. Which one would you choose, right? Instinctively, you would choose the $1,000 today. Why? Because the time value of money. Money available today has the potential to earn returns over time. This concept recognizes that the dollar today is worth a lot more than the dollar in the future. Um, let's consider like a practical example here using a concept of like present value and future value, symbolized by PV and FV. Imagine you have the option to receive $1,000 5 years from now. However, you would like to know what that $1,000 is worth in today's dollars, right? By using a discount rate to account for the time value of money, you can calculate the present value of $1,000 in 5 years. That might be about $800 today. The concept of compounding further magnifies the time value of money. Uh, like, let's imagine you invest $1,000 in a savings account with a 5% annual interest rate. After the first year, you'll earn $50 in interest, right? Simple math. It'll bring your total up to 1,050. In the second year, you will be earning interest on the new total of 1,050, leading to even higher earnings, right? So over time, with this compounding effect, and as it accelerates, this will allow you to your money to grow exponentially, right? And that's what we're all looking to do here, right? Let's be honest. Let me go to the next slide here. I'm getting better at presentations, so appreciate your patience, guys. Our expedition uh, is now going to take us into the diverse world of investment vehicles. Okay, this is going to offer a distinct pathway for us to be building wealth. Imagine you're considering the world of stocks. You decide to invest in a company known for its groundbreaking innovations such as Tesla, right? Everyone loves Tesla. By purchasing shares of Tesla, you become a partial owner of the company. As Tesla's electric vehicles gain popularity, right, in today's world, and the company's financial performance improves, the value of your shares could increase. Now, envision this. Sorry, my headset died here. Where were we? So, envisioning the stability of bonds, right? Um, Suppose a corporation needs to raise capital for expansion. To do so, companies can issue corporate bonds, allowing you, the investor, to lend money in exchange for periodic interest payments. When bonds mature, the corporation can repay your initial investment and provide you a predictable source of income. Now let's explore the world of mutual funds. Imagine you're a novice investor with limited research on individual stocks here, right? Instead of hoping that your stock does well, you can invest in a mutual fund that tracks the performance of the S&P 500. And this fund would then grant you much more exposure than a single stock by diversifying your portfolio into large U.S. companies and typically mutual funds are managed by investment professionals, right? Now, consider the real estate. You decide to invest in a real estate investment trust, which is called a REIT, Real Estate Investment Trust. Uh, by doing so, you would be indirectly investing a portion of your portfolio, right, into a income generating property such as apartment complexes, shopping malls, office buildings, right? As the REIT collects rent and appreciates in value, you would potentially benefit from both the rental income and the capital gains. Okay, let's go to the next slide here. Now, the investment strategies is interesting, right? This is where thoughtful approaches can lead to financial success. Let's imagine adopting a buy and hold strategy, right? This is where you purchase shares of a well-established company and hold on to them for the long term. Regardless of what the short-term market fluctuations do, typically, this strategy will allow you to capitalize on the power of compounding over time, which potentially could lead to substantial wealth accumulation. Now, if we go into value investing, let's say, suppose you come across a company whose stock has recently plummeted, right? They came out with some negative news. But you believe the company's intrinsic value is higher than its current market price that it's trading at. By investing when a stock is undervalued, you position yourself to benefit when the market actually realizes, oh wait, this is, you know, undervalued and it should be up because its true worth is actually higher, right? And then on the other hand, you also have growth investing. With growth investing, you would identify a promising tech startup, let's say, with a revolutionary product, that is going to disrupt the entire industry. While the company may not be profitable yet, you're still drawn to its like growth potential. And then by investing in this early stage company, you would aim to capitalize right on its future success, right? You're hoping on the company's growth. Let's go to the next slide. We're keeping up at a good pace here, I think. Hope all of you are learning and understanding at least the basics here. Now, for fundamental analysis, this is where the financial health of companies comes into focus, okay? Imagine you're considering investing into company A. To assess its potential, you collect fundamental analysis by analyzing its financial statements, right? Almost every company has them, right? You discover that the company's revenue has been constantly growing over the past 5 years, indicating a healthy demand for its products. Additionally, let's just say the profit margins have been expanding, suggesting efficient cost management. These positive indicators would provide you with confidence that the company's growth prospects are doing pretty good, right? On the flip side, let's consider company B. As we go into its financial statements, let's say we notice that there's declining revenue over the past few years, right? More so, let's say its profits margin have been shrinking due to rising expenses. Everything's more expensive in this world, let's be honest, right? Additionally, the company has a higher level of debt, which can also pose challenges to its financial stability, right? All these things for fundamental analysis, raises concern about company B's ability to generate sustainable return, right? So therefore, it might not look as good as the company A, right, that we went over. Moving on to slide 10 here. This is technical analysis. This is where price patterns and market psychology take the center stage, in a sense, right? Let's imagine you're a technical analyst examining the moving averages of the stock, right? Um, by plotting the 50-day, the 200-day moving averages on a chart, you would notice that the 50-day moving average has recently crossed above the 200-day moving average. This is something called the golden cross, and it's often interpreted as a bullish signal. This would indicate upward potential momentum in the stock's price. Okay. Uh, Now let's envision like the candlestick charts of a stock, right? You notice a recurring pattern of DOJI, I call it doji candlesticks, indicating indecision in the market, right? Suddenly, as you're watching this, a bullish engulfing pattern emerges. This is where a small red candlestick is followed by a much larger green candlestick. Uh, this pattern would suggest a potential reversal on its downtrend, signaling a shift towards bullish sentiment, right? These are just some of the things you can. There's tons of technical analysis you can do. I do plan to make more videos in the future going more in depth into it because there is so much analysis you can do in the stock market, right, guys? But once again, always do your own research. Just because it's saying that it's going to do one thing, it's not guaranteed, right? Slide 11, I'll hop into right momentarily. This is the end of this section. Welcome back. Um, as we are on slide 11, this is common mistakes to avoid. Okay, guys. Um, we as we dive into stocks, we want to equip ourselves with wisdom that we've learned to avoid common pitfalls that can really jeopardize our investments, right? Let's imagine a investor who fell prey to the alluring of overtrading, right? They frequently bought and sold stocks based on short-term market trends, incurring substantial transaction losses, right? Over time, these could erode your earnings or returns, right? Serving as a cautionary tale against the dangers of excessive trading. I do know a lot of trading platforms are, free for transactions, buying and selling. However, there are some platforms that do charge you per trade, and especially if you're doing over-the-counter stocks instead of buying stocks on the U.S. exchanges, right? There could be fees involved. So trading a bunch and racking up a bunch of fees is probably not a good thing for your portfolio, right? Now let's envision an investor who got over the temptation of market timing, right? Fearing an imminent market downturn. Let's just say someone sold their investments, right? Hoping to buy back in at a lower price. So, right, like let's imagine a stock kept going down. They sold their investments because they're like, well, I'll just buy back in when it goes lower. Unfortunately, they missed out on the gains as the market continued to rise, right? Um, this could go both ways, but you're never gonna time the market in a sense, right? It's more so time in the market, right? Um, this is just one example that could, show the challenge of accurately predicting market movements, right? Because anytime you buy or sell a stock, someone else is doing the exact same thing, right? When you sell a share, someone else is buying it. When you buy a share, someone else is selling, right? And you could think like, okay, as it's going down, I'm going to sell now, buy back when it's lower. But the moment you sell, it could just do a reversal and go straight up, right? Um, let's see. As we navigate through more investment mistakes, let me try to give you guys some knowledge of some more real life examples, right? Um, let's imagine an investor who was a part of the herd mentality, right? They invested in a popular stock, and simply because everyone else seemed to be doing so, right? GameStop, right? We all knew what happened with that a few years back, right? Unfortunately, the stock market's value plummeted when the market sentiment shifted, right? Leading to substantial losses for a lot of people, right? This serves as a stark reminder of, don't just blindly follow the crowd without conducting your proper research, right? Um, there were a lot of people that gained when GameStop went up, right? But once again, when everyone's like, "Oh, I'm gonna hop in," right? You don't want to be the last person to hop in, right? Because eventually things do come down, right? Like, there's always ups and downs in the stock market, right? Over time, stock market typically goes up, but we do have crisis here and there, right? Now let's consider an investment that fell victim to chasing hot trends, right? Another thing, right? They put a large portion of their portfolio into a single sector, right? Let's say electric vehicles, and they were expecting rapid growth, right? Or AI, right? Um, if for some reason EVs or AI slowed down, with all your portfolio into this hot trend, your portfolio might suffer, right? This example underscores the importance of maintaining a balanced and diversified portfolio. As we hop into the next slide here, um, tax considerations, right? There's a lot you can learn from and tax options, right? As you learn more about the stock market here. And they're very complicated at times, right? But let's imagine an investor who invested in a stock decide to sell it after holding it for only a few months. If it's less than a year, this would be considered a short-term capital gains tax. If you right, um, which typically is a higher tax rate than, for example, if you were to hold it longer than a year, which would be considered a long-term capital gain. Um, if the investor held the stock for over a year, you could enjoy like a lower tax rate on the gains, right? Which, if you're looking for to make money, you're also looking to save money, right? And the government has taxes, right? We can't avoid that. Well, most of us can't, right? Now let's envision an investor who maximized on the benefits of tax advantaged accounts, right? You contribute, let's just say, to an individual retirement account, which is an IRA. You probably heard that, and a 401k. This would allow your investments to grow tax free, right? And by the time you retire, or whoever invested in those retire, you would not only enjoy the growth of the investments, but also the saving on taxes, right? Ultimately, that would most likely lead you to a more secure retirement, right? Let's hop onto the next slide here. Now, uh, investment risk management, right? Um, there's risks, right? There just is. Let's imagine a investor who neglected to establish an emergency fund, right? Before diving into the world of investments here, right? If let's just say you're faced with a medical expense, right? Which I hope not, but could happen, right? And you're forced to sell your investments at a bad time, right? Like you're going to lock in those losses, and because obviously you need the money. This is just one scenario that signifies the importance of having a safety net, a financial safety net to weather unforeseen emergencies, right? Like always make sure you have enough to cover basic needs, pay your bills, emergency funds, right? Always a good thing. Let's also consider a scenario where an investor practiced the art of hedging. They were concerned about a potential market downturn, so they put investments into put options, right? So you own a stock, and now you're buying put options, which would allow you to sell stocks at a predetermined price. When the market eventually declined, the value of their put options increased, offsetting the losses in their stock portfolio, right? So you can there's tons of different ways you could risk management. Um, and just take these are just two examples, right? This is an introductory course, but I still like to, when I talk, provide examples and do the best that I can to explain to you guys, because I've been doing this for decades. It feels like. So I'm glad to share this and any bit of knowledge I can with you as it comes to mind, or as I can relay it to you in the best way possible, right? Slide 14 here is monitoring and review. Uh, let's imagine an investor who neglected to review your portfolio regularly, right? Over time, one investment grew significantly, right? It dominated your portfolio's allocation, right? So if you were to regularly review your investments, you could have noticed that this one stock went crazy, right? And it's now 50% of your portfolio. Well, now your diversification is a little bit off, right? So if you constantly check on your portfolio, you can readjust, you can sell some of your profits and you know re reallocate so you can have a more, once again, diversified portfolio. Because just because you buy a diversified portfolio doesn't mean it's going to stay that way, right? Um, Now, let's consider another scenario where an investor like actively monitors it, right? Um, you can see through like careful analysis, they determine, let's say, that the company's fundamentals had deteriorated in one of their stocks that they were holding, right? This could make you, make a informed decision, and then you could go ahead and sell the stock, and then reallocate the funds to more promising opportunities, right? Because once again, just because you buy a stock right away, and you think it's a good company, well, let's say months down the road you realize, oh well, it's not really a good company, right? Like things change, right, in the stock market, so you can, you know, take some out of that if it and put it into something else, right? Um, so hopefully you guys learned some stuff here. With this conclusion, I'd like to thank you guys for listening to me here, and hopefully you've gained some knowledge through some of the real world examples that I've given you. Um, I want to make sure that yeah, I really do like to give examples. I really do try to share my best with you. Another thing is, like, we can imagine an investor who embodied all the principles that I've taught in this course, right? With a diversified portfolio, you got some stocks, you got some bonds, you got some real estate. If you have all that and you're able to weather market storms, right? And you can navigate these uncertain waters of the stock market, right? If you understand risk and return, you can maintain a steady course towards your long-term objectives, which is always a good thing, and you could shield yourself from that turbulence in the short-term market fluctuations, right? It's much easier to predict what's going to happen to a stock 5 years out than what's going to happen tomorrow, right? Like, you could have the best stock in the world, but some bad news could come out tomorrow that makes the stock crash, right? So, just keep that in mind, right? As you dive into investments and as you begin your journey here, or if you've already been journeying, you'll know that this is both an art and a science, right? Um, so being armed with the insights into balancing risk and return, if you master diversification, and once you comprehend like the time value of money, you're much more likely to make informed strategic choices, right? Which is always a good thing. I'd also like to include on the last slide here, before we part ways, I'd like to give you guys, um, additional resources. Okay, so one of the books is called The Intelligent Investor. It's by Benjamin Graham. It's an enduring classic that imparts timeless investment wisdom. It's like a practical guide to understanding complexities of financial markets. Um, a random walk down Wall Street by Burton Mickle, Mackle. I don't know if I'm saying that right. Is also another good one, and that can provide you an in-depth exploration of investment strategies with both fundamental and technical in it. There's also going to be more courses by me coming out, so if you liked this one, make sure to give give me a thumbs up, give me a good review if you can, and I hope you will see me in the next course. Right? There's also online like platforms like Investopedia, pretty good. If you want to dive into investment concepts, there's a lot of explanations there. Typically, I like to listen to someone, right, like such as myself, but if you're eager, you can always hop in there as well, right? So once again, this was Introduction to Investment Principles. I appreciate all of you guys watching. Um, and remember that real world examples are a compass for us, right, to guide us through this maze, right? Like this is a big challenge. Don't get discouraged. Keep at it, and this is something where the more you do it, the better you're gonna get, right? And by embracing all these principles and anchoring them with tangible scenarios, you stand up very empowered to make well-informed decisions that once again can align with your financial goals, right? Your journey as an investor is a continuous learning experience, guys, right? And it's enriched by some of the insights I'm going to share here, right? Once again, I'm Mr. Wall Street. Thank you for embarking on this journey with me. May your investments voyage be marked by wisdom, prosperity, and the fulfillment of your financial aspirations. Well, thanks for watching, guys. Appreciate it.